Good afternoon and welcome everyone. My name is Danielle Stackis and I'm the Associate Director of Alumni Relations at the Robert H. Smith School of Business. We are excited that you are able to join us for today's webinar on becoming a savvy startup investor, presented by Elana Fine, the Executive Director of the Dingman Center for Entrepreneurship here at the Smith School. This webinar is part of the Office of Alumni Relations at Smith Professional Development Webinar Series, in which we hope to provide thought-provoking and valuable content that will help alumni like you achieve your personal and professional goals. During the webinar, we encourage you to use the chat box to share any questions or comments you might have for the presenter. Please feel free to submit questions throughout the session, and Elana will address them at the end of the presentation. As the Executive Director of the Dingman Center for Entrepreneurship, Elana's primary focus is leading the center in support of its mission to build a community that discovers, equips, connects, and celebrates entrepreneurs. In addition to this role, she also serves as an adjunct faculty member with the Management and Organization Department and is part of the National Teaching Team for NSF's I-Corps program. Elana is a Smith Terp, having graduated magna cum laude from the Business School in 1997 with a degree in finance. She also earned an MBA in Finance and Accounting from the University of Chicago Booth School of Business in 2002. And now we will get started. Elana, take it away.
Thank you, Danielle. Thank you for the introduction, and thank you to everyone who's joined us today. I'm also here with our Associate Director, Holly DeArmond.
Hello, everyone.
And we will be joined by Seth Scholdinger, our Venture Investment Manager as well. So I will dig right in. As Danielle mentioned, if you do have questions, we'll grab those at the end. So first, just a little bit on the Dingman Center for those of you who might not be familiar. We are a very mission-driven organization. As Danielle mentioned in my bio, we're really focused on building a community here in the Smith School that equips the next generation to launch and supports ventures that advance industry and society, connects the University of Maryland to the innovation economy, and leverages our thought leadership and our network to make entrepreneurs of all kinds more successful. And so when you think about one of the reasons, why are we doing this webinar? The first reason is to provide continuing education to our network of alums, specifically today on venture capital and angel investing, but also to just build awareness of the Dingman Center and potentially connect with you, who are on the webinar in a variety of ways. Our guiding principle here at the Dingman Center, which really drives us every day, is that we really believe that everybody can be an entrepreneur, and we look for entrepreneurs in lots of different places, and finding that more people to connect with us. The webinar is a great way to find people to connect with us. This is just a little bit more on the Dingman Center. You can learn more about us on our website and a variety of ways that I'll mention at the end. So diving into our webinar today, we're calling this the 6 W's of angel investing. And I'll talk a little bit later about the difference between angel investing and venture capital and other areas of investing. But I want to focus on the early stage of investing in companies, because we here at the Dingman Center, we run the Dingman Center Angels Investor Network. So we're very well versed in really the 6, like I said, have here, the who, what, why, when, where, and how of angel investing. And quite honestly, it's usually something that most people don't know a lot about. And so we thought this was a great way to educate our community, because we find that we talk to a lot of people and say, oh, we have this great angel investor network. And unless you've been involved in a technology startup or involved in venture capital, you might not know what angel and seed stage investing is. So I'm just going to kind of dig right in. And like we said, if you have questions, we can talk about them at the end. So just an overview of angel investing. There are not a lot of angel investors. If you think about it, only about 300,000 or so across, in the U.S. Obviously, others elsewhere, but angel investing is a pretty local thing that people do. And while the numbers do ebb and flow over the years, if you think about the size of the total economy, we're still representing a very small percentage of capital going into companies. But for us, people who play in the startup world, angel investing is a very important component of the financing life cycle, and we'll explain a little bit more of that, why, more of that now. A typical angel investor has already been investing, for 10 years or so. You don't find as many 25-year-old angel investors. We have some on the phone. We're not saying it's not something you can do, but it's certainly something, because of the risk and reward profile that I'll talk about soon. It really is somebody who's already had experience actively investing in companies, whether that's already in publicly traded companies or being involved in venture-backed companies yourself. You want to be pretty sophisticated to get involved in angel investing. Typical angels have about 10 investments in their portfolio at any given time. I'll talk later about the duration of these investments, but it's usually only a percentage of your asset allocation. Angel investments usually take a lot of time because you're working so close with the entrepreneur, and quite honestly, people just want to, because of the risk, only put so much money into investments. Like we said here, maybe about 10% of your wealth that you have disposable or that you have available for investments, you might put into an angel investing. And it is risky, and we'll talk a little bit more about that. But usually, angels, hopefully they can have one or two really great exits, and that helps fund the rest of their angel investing activities. So digging down a little bit deeper, who are angel investors, and am I one? Like I said before, usually pretty sophisticated. You have a sense of what you have a certain theory on your own investments or a certain scope of investments that you might be making. Like I said, about 40, usually in 40 to 60. You're educated. And some of these things I can touch on quickly, but I think the fourth bullet is really important. Most angel investors do have some kind of entrepreneurial or startup experience. We always kind of say here, like, oh, we wish we could have more lawyers, doctors, dentists, real estate executives involved in angel investing, but without great webinars such as these, people don't really feel like they understand what it is, and they also really often connect more with early stage companies if they've walked that path on their own. So we do see a lot of our angel investors understand the typical life cycle of a startup company, and understand kind of what it takes to invest in them and the kind of patience it takes to ride out the investment. The last thing I'll say is most angels do invest close to home. We say about within 100 miles you can get in a car and drive. One, because investors don't really want to spend lots of money having to go fly to investments around the country the way a venture capital firm might, but also they want to be able to stay close to the company and attend board meetings and be able to work closely with the entrepreneurs. So there's definitely some usual suspects in angel investing. On the left, we have Barbara Corcoran, familiar from, if any of Shark Tank fans out there, Brad Feld. Chris Sacca is a well-known angel investor. He was an early employee at Google, and he one early investor in Twitter. Probably sees some of the best deals in Silicon Valley. We consider these kind of super angels, so people who are really, really in the flow of deals and really kind of see companies and see investments before most people do. And then the right side, these are some great, the faces of the Dingman Center Angels, and it's more of your typical angel investor, not necessarily a quote unquote household name, but somebody who is very involved in the technology community and is interested in making investments for a variety of reasons. I think maybe one or two of these faces might even be on our call today. just to set the stage a little bit, the difference between a venture capitalist and an angel investor. And I'll talk about how this fits into the lifestyle of companies, but many of you might think of a venture capitalist and an angel investor as the same thing. In some ways, they are the same because they're all in the sector that we would call generally private equity. So these are private investments. You can't trade on the public markets. Once you're in these investments, you need to have some sort of liquidity event, either an IPO or an acquisition or a large funding round to get your money back out. So it's a private market versus being able to trade on the stock exchange. But venture capitalists and angel investors actually are quite different. The things that I would point out, one is that this is your own money as an angel investor. And so if you want to be investing very actively in specific companies and creating your own portfolio, it's really, you can go do that by being an angel investor. You'll typically invest $10,000 to $1,000 to $500,000 in any one company. It's your own money. You're using your own investment philosophy. You might be part of a group with friends and family that you do have an investment club with, or we have one investor in our group that he and his kids all put together money and they make decisions together on what entrepreneurs to invest in. So it's very personal, and you're putting your personal money on the line as an angel investor. It's different than being either being in venture capital, if some of you are on the phone kind of thinking about career paths, or investing in a venture fund. So venture funds venture capitalists are professional money managers. They raise a sum of money, anywhere from a $25 million fund to multi-billion-dollar funds, with a certain investment philosophy that is based on their expertise or their thesis about a market. And so they're making decisions to deliver a return to investors. They're investing very much, they're investing not their own money. So as you know, if you're using other people's money, you make decisions differently, and they'll typically invest after an angel investor will invest. So they're still taking on a significant amount of risk. Usually, we'll talk a little bit more about the stages of companies. They're taking on a significant amount of risk, but they're also doing it as part of probably a larger portfolio of companies that are part of their fund. Yeah, as mentioned here, venture funds raise money from insurance companies, endowments, family offices, and a lot of wealthy individuals who might also be angel investors. You might not know it, but some portion of your assets might already be in venture capital. You just don't know it because it's your insurance company or somebody else, pension fund, that has done that investing. So here's kind of this is I think a really helpful chart to understand if you are new to venture investing or new to startups in general. So if you almost kind of I would start at the right to understand this the best. Most of you, if you're in the market, you've invested in companies that have already gone public. But if you think about all the brand names particularly brand name tech companies that we use every day, Google, Netflix, Snapchat, all of them at some point went through this life cycle. But the reality is that there's a lot less companies on the later stage than those who are at the earlier stage. So companies typically start with an early stage concept. We usually suggest at that stage that they are getting some kind of grant money or money from, we'd say, friends and family. Assumes you have some rich aunt or uncle somewhere, which we kind of try to stay away from, because that's kind of eliminates the number of people we don't want to limit the number of people getting to startups, just assume that you have to have money from someone wealthy in your family. But the way the ecosystem has evolved, there's a lot of organizations, particularly locally through counties or state, that provide some initial grant funding for companies. And usually those grants don't require you to give away any equity in your company. as you move through, you do end up as an entrepreneur having to make a decision about whether you want to trade off getting investment, like is outlined here, for keeping, essentially the percentage of your company. But that's, kind of, thinking about it from the entrepreneur side. But thinking about, angel investors are usually, investing in between a concept and what we call really early stage startup phase. They're usually the first money in outside of, people who are very, very close to the company. They are understanding that they're very early on this curve and the risk is very high, but they're expecting that, that they will hopefully have some like a 3 to 10x return after investment period of 7 to 10 years. So that's why I was saying this is very different in private equity. Once you put your money into a company at angel stage, it's very hard to get it out because you can't just go. You might own shares of that company, but you won't be able to trade them on the public markets. This is usually the deals at an angel stage range from $250,000 to maybe $1 million, $1.5 million. Venture capital deals are usually right after that. So a company, although usually there's a couple angel rounds in there, but let's say a company will get started, they have an idea for a certain technology piece of software that will create a marketplace between two different groups. They want to get that marketplace up and running. They hack together some sort of initial prototype, might get a couple people on the platform, say, okay, there might be something here. We think there's some customers interested in it. And then they would go say, but we don't really have the money. Those customers aren't paying us enough to really build this out and start grow a company. So they'll go to angel investors and they'll say, okay, we think we have something here based on what we're seeing in the market. We'd like to raise $250,000 to $1 million to improve the technology, hire 1 or 2 additional people to focus on the product development and some initial sales, and then hopefully we'll prove out our model over the next 18 months, and then we'll either come back to you for some additional capital, or we'll go and talk to venture investors. What do we mean? Angels wear very many hats. For any parents out there, this is from one of my favorite kids' books, Caps for Sale. And so angels, in addition to investing in a company in exchange for usually equity or through a convertible note, you're now involved in the company, one as an investor, but also as a potential board member, an advisor or mentor. A lot of the role that you'll play is connecting. You now have a vested interest in this company being successful. So you'll want to be connecting them to customers, potential employees, the right legal advisors, anyone who might be able to help the company get to a next step. You'll also often be providing the business acumen. We have a lot of Smith grads on the webinar today. You can be very valuable to a technical co-founder who understands the technology, might understand a market, let's say like cybersecurity, but really doesn't know how to think through the business. They don't know how to think through making financial projections or understanding a supply chain, or thinking through how to make the right hires, or even thinking through the right way to be awarding equity in their company or fundraising. So there's a lot that business people can add to a startup company. And the last is really therapist. For anyone who's been involved with startups often have, they'll have their best days where the most amazing things happen. They land a big customer, they figure something out about their technology, they raise, funding, or their worst days when the technology crashes, their biggest customer walks away for some reason, or they didn't win. And usually those A days and those, D days are like right next to each other. And so it's really a roller coaster ride being involved in a startup, and investors who are experienced and have been through the hills and valleys of being in a startup can really help particularly younger entrepreneurs navigate through, the highs and lows of a startup. But any investor who gets in and thinks that they're just giving their money one time definitely learns quickly that it's a lot more than that. So why? I mentioned how risky this is. I mentioned that you won't be able to get your money back for a long time. Why do people do this? Why do people get involved in early stage investing? And while there's a lot of reasons, I'll summarize it in these 4 ways. One is kind of how the venture cycle works. So I mentioned Brad Feld and Chris Sacca earlier on. They've both been involved in startups. They see that somebody invests in an early stage company. They make they cash out because the company they were involved in did really well, and they keep that cycle going by making essentially bets on other early stage entrepreneurs. So it's a very important life cycle. Silicon Valley does it probably better than most as far as recycling money back into the ecosystem. I think the DC community has done a much better job of this over the last 10 years. But what happens is companies launch, they raise venture capital money, they go public, and all of a sudden there's instant bunch of millionaires running around. They're not sure where to spend their money, and in addition to buying houses and putting away money in their kids' 529 plans and giving to local charities, they do look to give back to the startup ecosystem. And it's a big part of how the startup ecosystem survive is through having angel investors in the community. And alongside of that is giving back, not just with your money, but with your time and experience to say, an angel gave me a chance years ago. Our company never would have taken off without, the $50,000 or $100,000 they invested. Now's my time to give back. The next is asset allocation, which I touched on. Obviously, the last 6 months have been a little bit unusual as far as returns in the public markets. But if you think about the random walk down Wall Street, if you invest in a certain percentage of your assets in higher risk investments such as angel, you can potentially beat the market over time by putting a certain percent, like I said on that first slide, 10% or less of your assets in angel investing. I will say that it is something that it's really hard to make money on it if you're just gonna if you have $20,000, which is a lot of money, but to make one $20,000 angel investment is really hard to make money on. So understanding that you're over time wanting to build a portfolio of angel investments is really important, because some of them will be home runs, or hopefully 1 or 2 of those 10 will be home runs. A couple of them will may exit for a reasonable amount, but over a long period of time. And a couple of them will go to zero. And that's kind of known in angel investing. So you have to really understand that you're building a portfolio of angel investments similar to you would with your rest of your portfolio. The last reason I'll say is that angels feel like they have their own personal alpha, meaning similar to a mutual fund manager. Given their experience, they feel like they can detect or sense an opportunity in a market earlier than others might, because they see talent really well in an entrepreneur, they know a sector really well, or they're just good at looking at being able to understand market and identify problems that need to be solved. Just really quickly to back up that point, angels, their expectations are that over 20 years that they're going to have definitely be a higher return than investing in the public markets, but they're taking on a much more significant risk to generate that return. Any Smith grad knows about the risk about risk return risk and reward profile. Wrong way. So if you're also on the phone and you're thinking, okay, one, I'm an entrepreneur and I don't actually know when my company should raise money from angel investors, or I'm interested in becoming an angel investor, but I have no idea, when I should invest or when a company is ready. These are just a couple of important tips to think about. One, a company has to be ready to give up some ownership and control. We talk about this a lot at the Dingman Center because one of the reasons, the biggest reason oftentimes that people become entrepreneurs is they want to work for themselves and they want to do their own thing. But yet then they start a company and 3 months later they walk in and they say, I want to raise angel money, I want to raise venture money. And that's really, those two things are sometimes competing, because when you do take any kind of outside capital, you are giving away a percentage ownership of your company and some control. Now, early on in angel investing, usually people might be maybe giving 10 to 15 to 20% of the company, of the equity, and so you still have a majority of the control. But once you head down that path to be a venture-backed or angel-backed company, you've kind of acknowledged that you're eventually going to be taking on more investors and more board members, which means more decision makers. The next is that the company will realize significant revenues. So not every company is right for angel investment. We sometimes use the word lifestyle companies. It's not my favorite word, but I haven't found a better word to use. But companies that do a great job in generating salaries and wealth for their founders on a year to year aren't always going to be angel investments. So angel investments usually have to have some sort of growth curve that will generate outsized returns in the future. So think about some of the companies I mentioned. You think about the unicorns that we think about, the Airbnbs, the Ubers, the Lyfts of the world. Those companies have scaled so quickly and have created have acquired such large market share. Those are the kinds of companies that angels are looking to invest in. They'll invest in lots of companies that never become that big, but that's kind of what they're hoping for. And the next one goes alongside with that, is that they need to be able to produce a return for the investors, not just for the employees and founders of the company. The last two also fit with the first one, is that you have to be willing to take advice from others, because that's why people want to get involved in angel investing. They want people to learn from their experience, and also an exit plan. So while investors are patient with having their money tied up for a number of years, they don't want their money tied up forever. And so same thing, entrepreneurs go in to work for themselves, and then once you take money from angel or venture investors, you've now put yourself on a path to eventually have some sort of exit for the company, and so you no longer no longer can dictate your own destiny necessarily. That being said, the other side of the coin is your company might go nowhere without investment, and so it's always that trade-off of understanding when the right and best time for you as an entrepreneur and for the future growth of your company, when is the best time to bring in dollars. These are just some more specifics on when you would invest into a company. These are the criteria that we use to evaluate companies, and this is what you would use if you were a member of the Dingman Center Angels. It's what we tell our students and teach them to include in their venture pitches and as they vet their businesses. But you really want to understand, does the entrepreneur really have a clear value for a specific target market? Can they articulate some kind of competitive advantage in the market? Why are they better, faster, cheaper? How have they mitigated their risk? Is it through some sort of intellectual property that will create barriers to entry from others, or have they been able to create partnerships based on previous experience that would help get them into the market faster? Have they been able to bring together the team necessary to execute? A lot of entrepreneurs, I think, forget to talk about or think about how important it is to bring your team together. Like I was mentioning, if you're a technical co-founder and you don't have anyone who has any business experience or connections in a certain industry, that's going to be viewed as a risk factor to an investor. Current traction, does this company already show that they have some users Do they show that there's going to be, have they validated that a customer wants to try out a platform? Have they shown that maybe they've already been able to generate some grant funding from an important organization? Anything to show that this is more than just a science experiment. Scalability I referred to already, that can this get to be, we show the typical like hockey chart growth, which most companies never really follow that exact hockey stick, but are you able to scale this business, or is it a very, very labor intensive business that for every new customer you have to add on 5 new employees and it just doesn't scale inexpensively? This is why I should have mentioned earlier, you do see most angel and venture investors are investing in technology companies and mostly even software companies, because once you create a platform or create a certain application or write certain lines of code, you're able to scale that very inexpensively. Think about how many people are on Facebook right now, and then how much it probably costs them, compared to how many people are on Facebook to run the platform. It doesn't cost them much per additional person that joins Facebook. Thinking through credible financials. This is why it's so important to have somebody with a business background involved in a startup, because you do need to be able to communicate a plan for the company. Even though if you're 6 months into a company, you're likely, any financial projections that you would do are going to be 99.9% wrong. But you need to be able to show to an investor that you understand where your revenue will be coming from. You can think through, okay, if I plan for these activities, these marketing activities, these sales activities, these other, if I'm out in the market for this, for this amount of time, I'm going to generate a certain amount of revenue, and I understand how much the cost is associated with generating that revenue, and then how else I'll fund the business from there. We spend a lot of time working with entrepreneurs on financials, and there's lots of debate over, we have lots of founders who come in and say, I don't need that. Why do I need financials? They're all going to be wrong. But it's just important to know that you have an understanding for the business the fundamentals that are going to be driving your business, and what people, and that you validated what customers are willing to pay in the market. We look at what the deal is and the valuation. This is something that I will say we talk a lot with entrepreneurs about also, because they sometimes look at the 8 things that are above this on this list and say, okay, all these things check out, but what they forget is that you could score high on everything else about your business, but if the deal itself doesn't make investment sense to an angel, they're not going to be interested. And we could do a whole follow-up session on this, on understanding early stage valuation and deals, but just to say that you have to remember that an angel investor wants to be able to have, is going to be owning a certain number of shares of your company. And over time, as you raise more money, the number of the shares of that company will be diluted, similar to anything you've done in public markets. And so the deal has to be good so that the angels have enough of the company early on that they can withstand, future dilution. And the last is the use of funds. An angel wants to hear from an angel wants to hear from an entrepreneur that they have a thoughtful plan for how they will use their funds. It's very frustrating as an angel when, even though it happens all the time, it's still frustrating when companies come in and they say, I need $500,000 and this is how far it'll get me and this is how I'll use it. And then they end up using the money in a very different way. And then they come back, 6 months later and say, I've burned through all the money. I didn't get as far as I want, and now I need more. Now, every angel needs to also understand that anything that an entrepreneur tells you, you need to assume that it'll cost twice as much and take twice as long. And that's why it's important to be sophisticated and be understand the dynamics of startups, because the reality is the entrepreneurs just don't know. This is a new company, a new market, and they might be creating a new sector altogether, and they just really sometimes don't know how much it's going to cost. And any one of these I'm happy to answer questions about, but these are generally the criteria that we would use. So if you're interested in becoming an angel investor, there's lots of places to find deals. This is a list of some of our local partners. if you're, we promote the events from obviously ourselves, but also our partners on our newsletter, The Pitch, and through our through social media, which I'll mention later. But these are all really, really great places to start going to see deals locally. Really quickly, I talked about, two kinds of, investment vehicles, thinking through how you make investments. The two categories of investments are usually a convertible note. So this is a form of debt that usually is a faster way to negotiate, because technically because you're not getting equity in the company, you're not putting a valuation on the company. And so a lot of angel deals are done at a standard convertible note, and then that note converts, those convert to shares in the company at a later funding round. Series C, these are standard documents that startups use to create, to provide equity into the company. So, but whenever you're giving equity in your company, you actually have to put a valuation on the company, which often is really hard to, value a company if it doesn't have revenue yet. It's in a new market, a bunch of other reasons that, companies a lot of times don't want to put a valuation on the company so early. But these are both, very, there's about, I would say, maybe 50-50 or maybe 60-40 more convertible notes versus equity deals. But it really depends on the investor and the entrepreneur. It's just important to note that as an entrepreneur and an investor, you do need to be savvy on, these investment vehicles and their investment terms. We work with a lot of great law firms who can really help guide you, because this is where you make the mistake that, comes to haunt you, a couple rounds later when you didn't, understand the terms of a deal. There's that scene in the Social Network movie where all of a sudden he's like out of the company because he didn't realize he could be diluted so much. But is really important. This is a lot of money you might be putting into a company. You really do, on both sides, need to understand, the terms before getting involved in deals. That's why being part of an angel network, which we'll talk about in a second, is really important, because if you're early to angel investing, you can, get engaged with, other investors who have more seasoned investors, and they can help guide you through some of your first investments. So now I wanted to turn it over to Seth Schuldinger, who's our venture investment manager, to just give a little bit of a highlights on the Dingman Center Angels, which is our angel investor group, and then we'll have some time for questions.
Hi, everyone. Thanks so much again for taking the time to attend the webinar today, and thanks, Elana, for kind of priming the pump for me here. I wanted to talk about, some of what angel investing looks like in practice, because the Dingman Center Angels is one of the more active angel groups, I think, in the region. And there's a lot of great learnings, and I'd like to talk about some of them. So the Dingman Angels currently is probably hovering around 40 members or so. And most of these people have been successful in one way or another coming out of industry. Most likely they've had companies in the past that they've managed to exit, and therefore have some liquid capital that they want to redeploy into some early stage companies. And perhaps even more important than their money is the fact that they have some really great domain expertise from their prior line of business or whichever company they were able to exit in the past. But that's not to say that we don't have a number of different angels from other career paths that have enabled them to make these types of investments. So in practice, what it looks like for Dingman Angels is that we meet about 7 times a year, and each time we meet, we typically have a funnel of about 20 or 30 early stage companies that wish to pitch our group. And through our screening process, we then winnow down those 20 or 30 opportunities to the best 6. And we have what's called a review day here at the Dingman Center, where we have a small subset of our angel network who gets together and reviews the opportunities along with myself, Elana Fine, and a number of our MBA students who we have as Dingman Angel Associates this year. And then once we go through those 6 companies, it's generally pretty clear who the group is most excited about moving forward with. And typically there's 3, sometimes 4, that we advance to the final Dingman Angels investor meeting. And those are, again, about 7 times a year. So those 3 companies will pitch at the meeting. And usually it also becomes clear which, 1 or 2 of those 3 angels want to move forward with. And from there, we will go into a more formal diligence process to kind of help move the investment towards close. And I just want to take a second to talk about the diligence process just for a minute, because it is something that I think differentiates the Dingman Angels from other angel groups. And we're pretty proud of how it's been working out this year. So one of the good things about the Dingman Angels is that we are on the campus of University of Maryland. So with that comes our ability to kind of leverage all of the resources that the university has at its disposal. And that varies from, professors and departments who have expertise in certain areas, all the way to the students. And the students have been a huge asset for us, the MBA students, because what we like to do is we first decipher the companies that are most interesting to our group, and then we move into a formal diligence process, as I mentioned before. And what that looks like is it's about a 3 or 4 week process where the students are working to kind of liaison between the founders of the company and the interested angels. And throughout that process, they kind of help to answer all the questions that the angels have, help with customer calls, market research, and other things that the angel group wants to find out before feeling comfortable with the investment. And then the MBA students crank out a 5 to 6 page investment memorandum that is akin to something that a Series A type institutional fund would go to their investment committee with before pulling the trigger on an investment. So this is both a really great experiential learning opportunity for the MBA students, but it also helps put a lot of horsepower behind our process and enable us to kind of go from a viable investment prospect all the way through doing the deal. And so when we actually end up doing a deal, as you'll see on the slide here, typically the Dingman Angels are good for about $150,000 to $250,000 total. And as Elana previously mentioned, these round sizes are probably about $500K up to maybe $1 million, sometimes a little bit bigger than that. So it is meaningful capital for the companies. And it's one of the things that I think we're pretty proud of here at the Dingman Center is the capacity of the group to invest meaningful capital. And also, as Elana mentioned earlier, it's usually only about 2 to 4 angels that are able to come up with that $150,000 to $250,000 that they're investing, say, $25,000 to $100,000 per check. And so the season for Dingman Angels is just now kind of getting underway. We're really excited that tomorrow is our first angel investment meeting of the year, and then we'll have 6 more after that. And so if this webinar has kind of got you guys excited and you feel like this is something that you'd like to give a shot, we definitely encourage you guys to reach out and explore coming to some meetings and getting involved.
And so here's just here's a couple slides. We'll be posting this slide deck, but if you just want to also go to our website, we have more details on the companies that are in our portfolio. The Dingman Center certainly prides itself on our portfolio over the that we have invested in over the last 10 years or so. If you go and dig down, and if you're familiar with some local companies, you'll see that a number of our companies have raised Series A, Series B, some Series C rounds, and we're starting to see some exits. Some recent companies, deals that we've done just of interest. Terbium Labs is a really interesting cybersecurity company that finds your personal information out on the dark webs. If you're familiar with that, but essentially when there's a major data leak or people steal, particularly like what just recently happened with Equifax, hackers often put that information out on the dark web and are able to sell it. This company goes in and is able to identify if your data, for example, if you're like Citigroup is one of their clients, I think, they'll be able to identify if any of Citigroup's customers' data is being sold on the dark web. So, this is an example of, our group invested in this deal a couple years ago. I had never even, I think, heard of the term dark web. And now if you follow cybersecurity or if you follow data leaks, you kind of hear of that more often. But angel investors have to be looking at companies from much earlier on and technologies from earlier on. One, a more consumer products focused company, Misfit Juicery. We really like this company because it also fits with our mission of helping social entrepreneurs. This is a group of young graduates, recent graduates from Georgetown, who have started a juice company that is made, trying to solve the food waste problem by making juice out of fruit and produce waste. You can get Misfit Juicery at a lot of local grocers, but they also have a pretty national footprint at this time. As Seth said, if you're intrigued and you're interested in next steps, you certainly check out our website to learn more about our investor network. But you can also just reach out to Seth directly to learn more and how you might be able to attend one of our upcoming meetings. If you're generally just interested, I'll take this a second before we have questions for some quick shameless self-promotion. But if you're interested more generally in startups and funding, the Dingman Center recently, or a year and a half ago, launched a podcast called Bootstrapped. For anyone in the DC area, I know that you have a long commute somewhere. And if you haven't gotten into podcasting yet, it's a great way to enrich your mind while sitting in traffic on the Beltway. But the Bootstrapped is in its third season. We've interviewed a number of really impressive entrepreneurs and funders from the University of Maryland, Dingman, and local community. You might recognize some of these names and faces, but really highly recommend this if you are just starting to get interested in startups and want to learn more about some startup fundamentals and local companies. And obviously, and we'll keep this slide up while we go to questions, we have multiple ways to connect with the Dingman Center, and either through following us on social media or to become a subscriber of our biweekly newsletter called The Pitch. So I'll turn it over to Holly I think we have some questions.
Sure. I'm happy to moderate the questions, Elana. Thank you. And just as a reminder to everyone, it's very simple. If you have a question, just post it in that question box, just like a chat, and we'll address it. But one of the first questions we had, Elana, is from Arthur, and he's saying, can you give us some tips on how to value a company raising angel money?
Yeah, Arthur, it's really, it's a good question. And I think a lot of angels struggle with the exact number. Usually, I would say a company that is raising angel money is usually has a valuation, I would say, between $2 and $5 million, and that's pre-money. So before taking your investment, that might be how they value it. It's not going to be based on any sort of calculation that you might do as a banker, like on looking at a multiple of revenue, because a lot of times they might not have it, or it's so negligent that it might not produce anything more than a $10,000 valuation. But usually they're in that range, because you could look at a company that's probably just started, has an early version of their technology, doesn't really have any customers, but has a team with some experience, that really is probably going to be around maybe like a $1.5 million, $2 million valuation. Things that are a little bit more fully formed, so they might already have 3 or 4 or 5 members of the team. They've brought some customers on. Their product is, they've been able to bootstrap their product and their company for longer, and so they've hit more milestones. You might see somewhere in a $5 to $6 million valuation range. So it's really hard. It usually comes out of negotiation, but angel investors usually have a cap on the valuation that they'll look at. So some of our investors, it doesn't make financial sense for them to invest in a valuation round below or above $5 or $6 million. Others feel like are less valuation sensitive and feel like they're investing for the longer run in a bigger picture, and so they might be less valuation sensitive.
Great. So a little more specific question. What are some pros and cons of doing a convertible note versus an equity deal?
Yeah, and Seth can certainly chime in as well on this. I think the pros of doing a convertible note are usually that they're faster, and because you don't have the negotiation back and forth of a on the valuation. And so you'll usually incur less legal fees. A lot of times angels will have a very, standard, convertible, note document, kind of sometimes take it or leave it terms. That's how, 500 startups, they were able to, do a lot of deals really quickly because they had very standard terms in a convertible note. So it's usually more entrepreneur friendly to do it that way. That being said, on equity, investors often want equity because they're putting in the riskiest capital. They're early on, and they want to be able to have shares and ownership in the company. Seth, do you want to add on to that?
Yeah, exactly. So I think that sometimes convertible notes are easier because it does kind of punt the specific valuation conversation down the road a little bit. They can be less desirable for investors sometimes if investors feel that at the time of investment the valuation of the business is substantially further away, typically lower than where the cap is being placed, because they feel that they should be compensated for putting that early money in and not have to risk that the valuation climbs too much before they convert into equity, even with the 20% discount that's typical. The other thing that's worth mentioning on notes versus equity is a lot of times when angel investors are investing, they are very cognizant of the tax implications. And so capital gains tax, as some of you are probably familiar with, is something that doesn't come into effect, the lower rate of capital gains tax doesn't come into effect until a year after investing. And it only applies for equity securities. So when you're investing in a convertible note, that clock on that 1 year time to get the capital gains rate, which is, I forget what it is, maybe 20%, 25%, but in any event, it's less than income tax. The clock doesn't start until you convert into equity. So, sometimes investors will be cognizant of that and opt for an equity security over a convertible debt. Those are just a couple of points.
Great, thank you both. And I think, Seth, you can handle this one too. Are there hard income requirements for attending the meetings or to become an angel investor?
So yes and no. I mean, generally, we do have accredited investors who are joining the network. And forgive me for not remembering the exact criteria of accredited investor.
You have to have, I think, $1 million in net worth, or $1 million in net worth, or a certain level of combined salary with your spouse.
Right. That's exactly right. I can't remember whether it's like $200,000 or $300,000 annually. It's probably something like that. Hopefully that helps. But it's that criteria should be pretty easy if we just throw it into Google or something.
Yeah, great. And I know one of the questions we get a lot is about the diligence process. So just to reiterate, Seth, I think one of the values of the Angels is we have these MBA students who are helping sort of newbie angel investors through that diligence process. That makes us unique, right? Yeah,
exactly. And so, I think one of the areas where the Dingman Angels really does shine is through that diligence process, because, angel investing is really great and it's super important for the startup ecosystem, especially at the early stages. But a lot of the times, angel groups tend to fall down in that diligence process just because people are writing individual checks. And so decision making is not as centralized and easy as it is with institutional funds. And so having that diligence process to kind of keep people organized and make sure that all the information around the deal is sort of centrally located and curated for everybody definitely goes a really long way.
Great, thank you. And I did have an easy question here. Can we get a copy of the slides? And yes, the Alumni Association will give those to all of the registrants. So that's an easy one for me to tackle. So another good question here. So do the angel investors get to participate in the diligence process, or what is kind of the role for them? How does that work?
Yeah, absolutely. I mean, the whole point of the diligence process is to make sure that investors are as comfortable as possible with the investment opportunity before stroking a check. So the process really is, driven by the questions and concerns that the angels have. The students are more there to help doing the legwork around getting the questions answered by the management team, or doing the research online, or talking to customers, etc. And so you could think of the students more as a liaison and just extra horsepower in the process, doing the legwork. And then sort of the content and the direction of the diligence is more shaped by the desires of the actual investors who are the angels.
Great, thank you, Seth. And so this is more of a resources question. So Elana, I don't know if you have a few ideas, but what are some other avenues to become aware of, the general angel process? Are there good websites or organizations to, to visit? I would just do another shameless plug to say we do have a few Bootstrapped episodes that feature angel investors who they share kind of their insights and their process, but are there other good resources for everyone?
Yeah, absolutely. Sites like Angel List or Crunchbase, other places that do show deals. The crowdfunding rules that changed 4 or 5 years ago have certainly created a lot of other opportunities for making investments, whether it's somewhere like Angel List or getting involved with places like Kickstarter, Indiegogo is a newer way to get involved with early stage investing. There's also some other local resources, like for example, Mava does a really good event called Tech Buzz that they do. Mava is the Mid-Atlantic Venture Association. They do an event, I think quarterly, where 20 companies locally will go to pitch, and so that's a little bit, might be less of a commitment than coming to a monthly meeting, but a good way to see some early stage companies and kind of understand what is in a venture pitch. Also, watching Shark Tank is a little bit of a guilty pleasure for a lot of us, but it really does. While I don't agree with many of the deals and the valuations, the way that the entrepreneurs have to pitch in a short amount of time is similar to our format. I hope that answered your question.
Great. So can you talk about how investors, bankers in later rounds would typically view or address a convertible note versus an angel seed investment?
Yeah, I think that they are familiar with both investment vehicles. A lot of venture capital firms, are now used to dealing with, seeing convertible notes. The only thing that's usually an issue is if a company is still an LLC at the time instead of a C Corp at the time of going to a venture investment. A lot of angels will not even invest in LLCs because of that reason, because they know that the venture firms will be less, will see that as less attractive for a whole variety of reasons that we could go into also in a whole other webinar. It's just a matter of what works best for the investors and for the entrepreneurs themselves.
Okay. We have time for maybe one more question. Anyone wants to post?
Yeah, I'll say, and then we only have a couple more minutes. I do think that the one thing I should have highlighted is that another reason that investors get involved with angel investing is also for educational purposes. And so I know it might seem like a lot of money to spend just to learn, but we don't suggest that be the only reason that you invest in companies. But for a lot of people who might be in between careers, that you've done something for a number of years, you might have some disposable income that you could use for this asset class. It is a really great way to connect with early stage companies and understand what the hot sectors might be, understand the challenges that the companies are facing, and to be in some way in the weeds of a company without being the founder or CEO and dealing with the daily headaches. So we do see often entrepreneurs, serial entrepreneurs who have or operators kind of get out of whatever the business they were doing for 20, 25 years and get involved with the Dingman Center and the Dingman Center Angels, invest in a number of companies, and then end up being the CEO of one of those companies. So it is a way to kind of also look at look for what your second act might be, or third act.
We have a second act.
Yes.
So great. Thank you, Elana and Seth. And I think we're going to throw it back to Danielle with the Alumni Association to close this out.
Yes, thank you to Elana, Seth, and Holly for this really helpful information. We will be sending a follow-up email with the slides and a recording of the webinar, so watch out for that. And we also hope to see you all all at our next webinar, which is next Tuesday, September 19th. It's Shifting Your Identity, the Key to Succeeding in Your Next Role. We hope you all have a wonderful afternoon, and go Terps.
Go Terps. Thanks, everyone.